Welcome to my mid-year investor update. Today's agenda is straightforward. First, I'll share a brief update. Then I'll discuss some ideas and strategies you can consider. Before I get to the presentation, I'd like to take a minute to remind you to stay safe. Please try to stay positive. We're still experiencing challenging and unprecedented times, but as the famous poet Virgil said over 2,000 years ago, the greatest wealth is health. I find it's always important to review that there's 5 key areas of financial planning, and a good plan reviews these areas. Even though today's presentation is about the equity markets, as a CFP professional, I try to consider the impact of any recommendation I make on not just one, but all these for our clients. In his famous novel, A Tale of Two Cities, Charles Dickens started out by saying it was the best of times, it was the worst of times. The first half of 2020 has been like the best of times and the worst of times. In mid-February, after making new all-time highs, a silent but deadly virus quickly decimated an 11-year bull market, and in less than 3 weeks during March, the S&P 500 fell from a 52-week high to a 52-week low. This quick waterfall of the equity markets has set many records, but for those investors that did not panic, the second quarter of 2020 recovered some. As of the July 2nd midpoint, large U.S. company equity markets were very close to where they initially started the year, with a more significant rebound than other equity markets. Second quarter results were strong, and investors who did not panic were rewarded. The Dow Jones Industrial Average posted its best second quarter performance since 1938. The S&P 500 ended with its largest quarterly gain since 1998, and the NASDAQ, an index that's heavily weighted in technology stocks or .com stocks, made an all-time high during the quarter. We like to say that panic's not a plan. Investors who panicked and sold their positions mid-March may have missed out on some substantial account recovery. Although equity markets have moved significantly higher at mid-year, investors still faced some of the issues with bond yields, unemployment, COVID-19 news, and other issues. The Federal Reserve lowered the federal funds rate in mid-March to a range between 0 and 0.25%. At their June session, Fed Chairman Powell stressed that the pace of the recovery is dependent on the path of the coronavirus. He specifically said, "We're not thinking about raising rates. What we're thinking about is providing support for the economy. We think this is going to take some time." Central bankers also projected at the June session that the economy will shrink 6.5% in 2020. Then for 21, they forecast a 5% gain, followed by 3.5% in 2022, both well above the economy's longer-term trend. The all-time low for the Fed funds rate is effectively 0. It's only lowered the rate to a range that it is now twice, once during the financial crisis of 2008 and now again in 2020. This makes the market environment tough for those trying to save in a bank account because the inflation rate is higher than the interest rate in that account. So what's the potential true cost of safer investments? As you can see here and likely see on your bank statements, interest payments on cash in the bank is very low right now. For many investors, these low rates might not help them reach their goals. Therefore, equities investments might be part of something diversified in a portfolio. Although the equity markets are not the economy, many experts conclude that the stock market is an excellent economic indicator of the U.S. economy. Their hypothesis is that equity markets reflect how well all the listed companies are doing. Typically, if the investors are confident, they'll buy stocks. So let's look at how the economy was initially affected by COVID-19 and how it's recovering. As this chart shows, after a decade of mostly growth, the first quarter of gross domestic product, or GDP, growth was a negative 5%, the worst seen in well over a decade. How we recover from here is crucial. We always feel a knowledgeable investor is the best investor. So let's quickly review some of the more common economic recovery scenarios. They're usually referred to as the V, W, and L shape because that's what their graph looks like. A V-shaped recovery is a sharp decline and then a quick rebound. And W-shaped recovery is considered a double dip recovery. And an L-shaped recovery is a sudden plunge and then a fitful recovery. 2001, 2008 kind of looked like that W-shaped recovery. Barron's Magazine July 6th edition had an analyst roundtable that offered 3 potential second half directions for equity investors. And as you can imagine, there was the worst base and bullish case for what that would look like. And no one can predict with certainty where things will go, but we can probably agree that it's going to be interesting. While prior equity market performance is no assurance of the present performance, as this chart shows, post-World War II, bull markets have been far more robust than bear markets, and they've lasted considerably longer. While every market decline is unique, over the past 70 years, the average bear market has lasted 14 months and resulted in an average loss of 33%. By contrast, the average bull market has run for 72 months, or more than 5 times longer, and the average gain has been 279%. Please keep in mind, for now, volatility in the equity markets has reemerged. After several years of limited volatility in the first half of 2020, investors have seen more market movement days of up or downward 2.5% movements than in almost every year since the 2008 financial crisis. So how should an investor move forward? One of my responsibilities is to look at all situations and guide clients with ideas. My main goal is to consistently search for opportunities. Let's review some of them. Maintaining a properly designed and well-diversified portfolio is important. And during this volatility, we're regularly reviewing your accounts, looking for opportunities to sell high-priced investments and buying those on sale. Also, given historically low current tax rates and historically high federal debt, looking at possible Roth IRA conversions is something to think about, and a number of clients have already taken advantage of. When our office calls you for a regular review of our plan together, one agenda item is reviewing your current risk level. If life circumstances have changed since we last met, or the events of 2020 have made you want to reevaluate that risk level of your investments, it's important that we discuss the pros and cons of any changes together and make decisions based on your financial needs and not on emotional reactions. Even though large U.S. companies, particularly growth-oriented companies, have recovered much of the losses of the first quarter, they've increased risk by having a current price well above their average price. We are continually working to find good investment opportunities in large and small companies in the U.S. and outside the U.S. with solid fundamentals and a reasonable price. We also create portfolios that will provide stability and income for our clients with a more conservative investment goal or savings they want to preserve. As a recap, what are some key takeaways for investors? First half of 2020 has been a wild ride for equity investors. Extreme volatility has emerged. Your health is our top priority, especially in these times, so we're offering phone calls, video chats. Masks can be worn for in-office meetings at your option. And we continue to focus on your personal goals. Call us with any concerns. What can you expect from us? You can expect regular communication, more frequent discussions, and you can expect that we're continually reviewing economic, tax, estate, and investment issues for our clients. Thank you for your time. Remember, your health and well-being is our priority. We appreciate the opportunity to assist you. We would like to help others in 2020 as you've been spreading the word about our extra mile service. It's shown in the referrals that have come in this year. We'd be honored if you could share some names of friends to add to our mailing list so that they can benefit from this information or service. Feel comfortable letting us know anyone we could help. Thank you for watching this mid-year review, and then here's some fun disclosure for your pleasure reading. Have a great one.